Welcome to the Dividend Talk podcast, episode 89. It's all about dividend safety. Hey guys, welcome back to another episode of Dividend Talk. Today we're just going to talk about dividend safety and some companies in our portfolio who might concern us. All that and more. See you on the inside. Hey, European DJ. How are you this Saturday evening?
This Ukraine shit is on my mind, of course, all the time.
Yeah, of course.
So, yeah, it's been horrible. All these images that are coming through. I don't live too far away from the Ukraine border, so it's quite surreal, I would say. All.
Yeah, I've been following stuff online on Twitter and other places, and it's quite sobering, I think, to see what is happening and what can happen. And look, we know this is not isolated to just Ukraine. There's lots of places where war happens, but to see it so close to us is a little bit closer to you than me, of course, but it's still a little bit sobering to see what's happening.
Yeah, so we're just trying to see how we can help. We have registered our house as a shelter for people if they need to stay over for the night. So I'm just waiting for a phone call, effectively. Yeah, it's really coming close. But what is so nice to see is how the Polish people respond here. I mean, yes, Ukrainian people are definitely the heroes here, and how they are standing up to this. But then if I see how the Polish people are like literally just going to the border to help whatever they can, it is like at least there's also some good stuff coming out of this to see the
Yeah,
solidarity. And I'm not sure if people understand that when you're from West Europe, but there's such a strong history between Poland and Ukraine. They are like brothers of each other, right? So
yeah,
also quite some Ukrainians that are working here, where my friends told me like that their employees just left back to fight in Ukraine. It's quite a thing, I would say.
yeah, yeah. It's. I mean, look, I'm too far west for it to impact me directly, I
Hmm.
suppose. But I mean, we're well aware we've been troubles over this side of the world at some point as well. So we're well aware of the effects that it has, and it's great to see I think it's making Europeans a little bit stronger. They're starting to come together, and humanity. I mean, look, what annoys me is that the people that order these wars. I mean, they sit in their bunkers, they sit in palaces, and they give out orders, and they send out other people to do the fighting, and it's not right. Um, but I just hope it stops soon for everybody's sake.
Yeah. So I can tell you my savings rate will be a little bit lower this month because we've also been donating. Also, when people are listening, if there's anything you could do, is just best donate, I believe,
Mm,
because blankets and such are, I think, already in well covered here. But for instance, people need, for instance, power banks at the moment. Yeah, they come off the train, empty
yeah,
phone. They need to load their phone as quick as possible to call their family. So in that case, I would just say like it's really hard to figure out what people need at that moment in time, and
yeah,
and what goods are in demand. So I would really just stick to sending money if you want to participate.
yeah. I mean, it's no surprise then that the war has dominated news. Any outlet, it seems to be there. So from an investing perspective, or maybe we just bring it back into our own world, th- there's a lot of companies out there that have stopped doing business with Russia. There's a little bit of a backlash I've seen today of companies such as the known Unilever, Coca-Cola that are still doing business in
Hmm.
there. And we know Shell have decided to ditch, some of their Russian businesses. Now, a little bit deceiving. I mean, yes, they're ditching some of their businesses, but they are still buying Russian oil at
Yeah,
huge discounts as well. But it's the effect that this is having throughout the markets is huge. We see obviously currency is obviously when I think you're starting to see that more so from the zloty side. Um,
hmm,
but then we will obviously the price of commodities has gone up, and it's It's a little bit concerning, and that's I suppose that's why we're talking a little bit about dividend safety. We talk about our portfolios to weather all storms, or how we react in crises, or when the markets go down. So I think it's a good topic today.
Yeah, and also I know that specifically in the Polish community, there were quite some people with Gazprom as an investment, and
Yeah,
it went effectively almost to zero, right, for them because stock market has been closed. So I feel for the listeners that had investments in Gazprom. I just really hope that they, when at least when they follow us for some time, that they had a well diversified portfolio. So that what I always say, like I don't want the company be more than, let's say, 4 or 5% of my total portfolio or dividend income dependent, so that you don't effectively lose your whole dividend income or your portfolio, right? So for me, that is an important thing, and I really hope that people, that owned Gazprom or still own Gazprom, have it in a well diversified portfolio. And if not, then I hope it's a lesson. Let's say that we shouldn't have too much single stock risk in a portfolio.
yeah. I mean, investing is risky, and sometimes we might make it seem like it's not as risky. We talk about dividends. Dividend investing is one of the more, how would I say, safer investments, but that still comes with risk. And if a company goes out of business, or trades at zero, then you're going to lose all your money. So you do have to be wary of that, and like you said, maybe try and diversify across different companies, and maybe even different asset classes,
And different countries. Yeah.
different countries. Yeah, yeah.
Yeah.
So we'll just maybe talk a little bit about our ideas of what dividend safety is, what we use. I know I have it on my dashboard. You have it in your dashboard. We have dividend safety, and there's some metrics, underlying metrics in behind that. And I think it's quite common. Maybe they're probably the same metrics most people use, but I suppose we look at 4 or 5 key areas: bottom line growth, balance sheet, payout ratios. Obviously, dividend growth comes into it, and then the future of the company. So we might just talk a little bit about bottom line growth, and what does that mean to you? What is bottom line growth, and
Yeah.
how do you incorporate that?
So you have top line growth, that will be for me the sales, the revenues, and then bottom line growth is the EPS and the free cash flow. To be honest, I'm not so interested so much in revenue growth, because specifically when you look at some companies like Unilever or others, they're holding companies, and one of their main jobs for every CEO is capital allocation, but they also do it from a portfolio management point of view. So what is way more important there is the margins, as an example, but that makes it all quite complex. And that's why I look at EPS growth and free cash flow growth over time, because sometimes they swap out or they sell off a part of the business, spin off a part of the business, and buy something maybe that creates less sales, but then still that the EPS is doing better because of the differences in margins. So that's why top line growth for me in itself for these mature companies doesn't say me too much. Also with the buyback programs that they have.
Yeah.
So that's why for me, I rather look at bottom line growth. And if I talk about free cash flow growth, earnings growth, I look at 5-year growth and 1-year growth. So 5-year growth, I want to see a positive trend, right? That it's positive, but I also want to see like quickly on the radar, like what was it the growth compared to last year? Because sometimes the 5-year growth looks really nice, but then it was still based on things that happened 4 or 5 years ago, like a big bump or something like that, or a big acquisition, like Ahold Delhaize Ahold acquiring Delhaize, right? So I need to have those from different time perspectives. Yeah, and that's why bottom line growth for me is important, because in the end, cash is king, and I don't care so much therefore about the revenue. Of course, when you see declining revenue year over year, like IBM, you get worried. But IBM also came with earnings decline, right? So it was not just a top line decline.
Yeah. Yeah, I do like to see top line growth. Well, at least not declining, because to me that's the first red flag. If there's no structural changes in the company, so they haven't divested a part of their business, or anything like that. If all things remain equal, and you start to see revenue
Oh,
declining,
that's a different thing. Yeah, indeed.
then you're going to see that affected in the bottom line growth. So I
Yeah,
do I
true.
do I do check that. It doesn't come into my it doesn't come into my dividend safety score and metrics, but
Yeah.
it's definitely the first thing I look at because I just want to make sure it's not declining.
Well, it tells a story, right? If you suddenly see a 20% drop in revenue year over year, you go naturally, you go into the annual report and try to figure out why is this? Yeah, and
Yeah.
then you can see that they did a spin-off, like for instance, Siemens did, right, with Siemens Energy,
Yes. Yeah. Yeah.
and then it's indeed important. Yeah,
Yeah.
yeah,
But for me, it would out of both, I prefer to see free cash flow growth because
yeah, me too.
that's where your dividend is paid from. It's not paid from earnings. And I know people
Yeah,
always use that metric and payout ratio, but I like to see free if earnings is not growing, if it's flat, but they have a strong a strong free cash flow growth, then I'm happy. But if it was the other way around, if free cash flow
yeah.
is not growing but earnings is, I'm probably a little bit more concerned.
Yeah, and also the earnings per share doesn't tell the full story, right? For instance, if you look at pharma companies, they have a lot of amortization based on past R&D investments, right?
Yeah.
That's why the EPS looks always lower. Their core EPS or their adjusted EPS always now looks always better than the GAAP EPS, and that's because of the amortizations. But the free cash flow for a pharma company tells a much better story. Of course, you need to look at in that context also a little bit about what they are investing, right?
Yeah.
So is the cash flow sustainable? And we've seen that with Intel. Intel has been under investing in the business, therefore they have really nice free cash flow growth. And now they need to make up for it, and you see that the free cash flow gets hammered because the capex is needs to increase.
Yeah.
So the just the bottom line growth itself gives us like only the first part of the story, right? But it's so important to look at also at on top of this at around how are they investing and such as well.
Yeah.
But to have a part of screening, it will be really like indeed the cash flow the most important. Yeah,
Yeah. Yeah. And I think you touched on a point. We use these, you can call these metrics, and metrics are useful as a guide, but I think I don't think if a company ticks all these boxes, and I'll give an example of that when we get to our companies,
yeah,
that it means their dividend is entirely safe. So
yeah,
it's just used as a guide to give you maybe a brief overview, but I would not just solely rely on these metrics. But one of the most, arguably for me, one of the most important things is balance sheet strength.
hmm
We spoke about the balance sheet on this show before. Um, we went through why it's important and what we see in there and what we look for first. And maybe some things that we didn't touch on, but is something like credit rating. So do you take credit rating into account when you're looking at a company?
yeah, definitely, because the credit rating determines a lot the cost of debt. Yeah,
Mhm.
so what interest rate their bonds can be put into the market. You want to have it as cheap as possible. Yeah, so that's why Johnson Johnson, Microsoft have an edge towards their competition because they can acquire cheaper debt. That's right. What I've also seen over the years is that actually the credit rating agencies do quite a good job. I have always been skeptical towards these institutions because, for instance, after watching The Big Short, seeing how banks suddenly went from I don't know, a double A or a triple A to junk bonds overnight,
Yeah.
yeah, it made me really, really skeptical. And there is, I think, an incentive problem with credit rating agencies generally. However, at least during these good times, I have found them to be quite accurate because if you look at some of the others that we will soon talk about, all of these components actually make up a lot of the credit ratings that agencies are giving. They're also looking at future cash flow power, as an
Yeah.
example. Yeah, so I said I do look at those. For instance, if I see something starting with a B, I'm already wondering like, okay, what I'm going to discover soon. Is the
Yeah.
interest coverage rate really low or something like that?
Yeah. What I find useful is I have an account with Moody's, the credit rating, and actually when you're researching a company, I know we say read the 10Ks, but sometimes if you just log on there, they have a lot of research done, and they write articles, so maybe once or twice a year on every company they cover, and it's pretty in depth. It gives you a good picture of the company, where they see the risks, where they see potential future risks, and what they want that company to do to improve the credit rating. So you get a really good snapshot just by reading some of their reports. So that's one thing I think is often overlooked.
Yeah, yeah, exactly. And that's why I'm always looking it up, these kinds of things. And yeah, I think Moody's is one of those that I actually appreciate the most from the credit rating agencies.
I just use Moody's exclusively. I think
Yeah.
I don't cross reference, but um, and then looking at some of the other components, obviously debt to equity, it's quite a popular metric that people use. And look, obviously, the more debt the company has, the more likely it is that they might cut a dividend. And it's the same. Then
Yeah.
it's the same with interest coverage, current ratio, quick ratios. I mean, they're all in and around the same thing. You're looking at the liquidity. Can the company pay their short-term and long-term debts? How likely
Yeah.
is it that they can afford it? And the higher these ratios are, the more likely it is that you might see a dividend cut.
Yeah. So I typically would like to have companies with a debt to equity ratio under 60%. But it depends because a lot is also industry dependent. I give you
Yeah,
an example. Ahold, I don't know the latest numbers. They will probably have a high debt to equity ratio. Probably they have more debt than equity. This is because it's such a slow compounding company. Yeah, that they're in the supermarket business, right? So they can have more debt because how is it their revenue is not dropping overnight with 30 or 40%, yeah, because people will need food, so they're really serving the bottom of the Maslow pyramid. So in that case you see that companies that have a really stable business model that don't have a lot of revenue growth overnight but also not revenue decline, they usually have more debt on the balance sheet because they can easily afford it because they have a more stable income stream. Yeah. So you need to not only, I think, because in the dividend investing community, 60% is kind of really, really popular and you see it a lot. But I would also argue like, don't use it as a screening criteria to straight away exclude companies. Look also a little bit about what the industry is doing and whether they indeed have such a how is it such a revenue certainty, let's say, because
yeah,
then I mean, if I knew that I could buy a house here and there would be like for 10 years revenue coming in from rentals, yeah, I would max it out with debt. Yeah, if I would have uncertainty that it would be only like 5 or 6 months per year,
yeah,
or under bad times 4 months per year, I would not max it out. Yeah, I would keep my how is it? I will keep my how is it? My debt coverage ratio or interest cover. I would keep it, really healthy.
yeah. I mean, I always compare it to industries really because, as you said, it is industry specific. One website I find really good is readyratios.com. Now, the downside is it's only for American
US.
companies. Yeah, it's
Yeah.
not as usual. But I find it really good, and it's just good to compare against your peers. For
Hmm.
European companies, you have to, unfortunately, at the moment, do a lot of that digging yourself.
Yeah.
But yeah, I kind of came away from having hard and fast numbers because, like you said, you tend to screen out some companies that maybe should be in there, and vice versa. So I always try and keep it specific to the industry and compare against our peers, just to
Yeah.
see how they do.
Yeah.
And what about payout ratios? Then they're quite popular.
Yeah, it's similar here. I prefer payout ratios below 60% again. It means that they have 40% left for buybacks, but also for reinvestment, for strengthening the balance sheet. But also when they have some few bad years, that they can still increase. Yeah, like if they have few flat years in cash flow growth, they
Yep.
could still increase. So that's why I like 60%. It gives this kind of sweet spot, I believe, I said serving my interests versus the safety in general, also a profile of the company. Again, here for a tobacco company, you might probably expect 80% payout ratio because they kind of grow in line with the cash flow growth, the dividends. But generally, I would like to say below 60. And if it's too long above 60, I would really want to understand why is this, and is there something specific here?
It's one of the key differences, isn't it, in American and European companies is the payout ratio. Typically, you would see the US based companies on the upper end of that scale. So typically close to 60, even above that. I allow up to about 70%. European companies, on the other hand, if they start getting above 40 or 50%, it's quite unusual. They tend to stay below that. So I would view them differently. If I see a US company at 60%, I'm not overly concerned. Whereas if I
Mm.
see a European company at 60%, okay, is it's not as normal
But it
as
depends on the dividend policy,
yeah, of course.
because most European companies don't have a progressive dividend policy. They have a policy to pay out between 30 and 40%
Yeah,
of their cash flow, right?
yeah,
And most American companies have a progressive dividend
mm,
policy. I guess this is also why we have only few dividend aristocrats in Europe, yeah,
yeah.
because dividend cuts are likely here.
And that sentence alone reiterates why we go back to bottom line growth, free cash flow growth,
Yes,
because of that dividend policy that they have. They are telling you they are not going to grow this dividend if their free cash flow
yeah.
is not growing, pretty much.
Yeah, and which also means that from that point of view, that how you said that the companies are more focused on protecting their balance sheet in
Yeah,
Europe, and that's also why you see that European companies often pay really high dividends as well, because their balance sheets can allow for it, right? And then also usually they have lower multiples. But it's probably good to mention, like we are going through these topics, but for me, this is also the prioritization. For me, the most important is bottom line growth, then the balance sheet strength, then the payout ratios.
yeah.
Yeah, and not the way around.
No, of course, yeah. I 100% agree with that. And then after that, then we start looking at some of our dividend metrics,
Yeah.
which would be pretty much at the bottom of the point. It's strange because we're dividend investors, but it's probably one of the last things we look at, which
Yeah,
is the
yeah,
dividend.
exactly. Because we want to invest in businesses first of all that can still exist in 20 years from now.
Mm,
Now we are not Nostradamus that we can predict things, but yeah, we invest in businesses, not in stocks. Yeah,
yeah,
so to make sure that we have dividend growth, we need to understand the business, and we want to see a healthy business.
yeah,
Doing the way around, I'm afraid I will fall in love with a stock too quickly, and then start justifying the poor behavior of the business or something like that.
yeah. I mean, doing it the other way around kind of opens you up to falling into that yield trap that most dividend
Yes.
investors,
Yeah.
including myself, have fell into. And you'll notice we have not once mentioned dividend yield, and it's not something that we even consider in
It's not relevant for dividend safety. It's
yeah,
relevant for your investment decision.
yeah, exactly. So it's as you said, not relevant here. What we do look at is how did they perform at during the last recession, or maybe the last two recessions. So you're looking at
Yeah.
the pandemic and then going back to the great financial crash. How what did they do? Did they suspend their dividend? Did they cut it? Did they freeze it? I know companies can change. I think Bayer is one such company. Like they've really started. I think they've come out and said that they want to increase their dividend, which was different before the last financial crash. But how they perform in that is usually a good indication of how they will perform during the next one.
Yes, exactly. And also shows like how committed is the management to the dividend, right? Because it's easy to commit when the sun is shining, yeah. But if trees are falling on your house, then
Yeah,
that's where the real power comes in. So that's why it's really important for me. And I know that management also changes over the years. Most of the CEOs that are ruling the companies today were not ruling during the Great Recession. But we have seen already some of the cowards and some of the heroes during the pandemic, right? There were companies that really quickly decided to postpone their dividend or to cut their dividend, while others said, like, okay, let's wait it out with the pandemic. We don't need to make a decision now. We postpone it a few months. And those companies have generally done better for us as investors because the cash was still coming in for us.
with one exception, and that's Royal or Shell, as they're now known.
Yeah,
They were
yeah, 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 yeah.
they were
True.
pretty quick to cut. I think we both discussed it at the time and said it was a little bit too early.
Yeah.
But European companies tend, as you said, they try and protect first rather than so. I'm happy if a company doesn't cut them during them times. If they keep it steady, that doesn't bother. Steady or preferably growing, but I don't like to
Yeah,
see.
and this is what I don't always understand. There, and I think specifically our American colleagues, dividend investors, if there is a flat dividend, they treat it as a dividend cut.
Mm,
And okay, maybe because we are in Europe that we need to take. If we would not allow this, we could just sell all our European companies probably at a certain moment.
yeah,
But for me, it is like, okay, I had not the best year, so my salary was frozen. Yeah, that's fine. I understand. Companies going through a difficult time. I'm not so. It's inflation, of course. But if you then see now European companies this year, like for instance L'Oreal, a 20% increase, they are making up for this, and I'm totally fine with flat dividends. But for instance, if there's a company and there's one of those, I forgot which European company, like for the third or the fourth time in a row,
yeah.
yeah, those are really companies you need to look after now. Like, why is it that they are not growing the dividends for 3 or 4 years in a row? What's going on here?
I think the difference with American companies is that they're chasing that status, or if they have that status of a dividend aristocrat. And I put out a comment on Twitter. It was quite controversial. A lot of people didn't agree, but having a status is not important to me. Okay, but it appears it's important to a lot of people, and they think that if they were to lose that status, such as AT&T, and just keep it steady, it'll have a huge detrimental effect because you have fund selling and investor selling and so on. So it's more prominent over there because that status is a lot more evident in the US than over here. Like you don't hear a whole lot about European aristocrats.
But I'm changing that with the Noble 30 index.
Of
Yeah.
course, yeah.
Now, of course, CEOs they come to my blog, they read it, and they think like, "Fuck, better not do a dividend freeze or a dividend cut, because we might drop from the Noble 30 index, right?"
Yeah, but also in the Noble 30 index, or in even if you look at the ETFs around dividend achievers in Europe, they do not consider keeping it steady as drop losing that status. You get away.
But
Yeah,
the ETFs about European dividend stocks, they really suck because they usually only look at 10 years or 5 years. Some of them they call them dividend ETF, but then they only look at the high yielders in the Euro
yeah,
stocks or something like that. For these rules, if you look them, they're really stupid. They're really, really not aligned with the how is it with dividend growth investors. Maybe with dividend investors, but not with dividend growth investors. You really need to stay away from actually all of them, I would say. So I'm not saying with American or European ETFs, but because also American ETFs focusing on European dividend stocks, really read their policies, their
like
KIID.
key
Yeah,
invest.
you need to read that document, what it is about. And sometimes it's really confusing because it refers to, we track this other index, and then you need to Google the other index to see how it's being compiled. I, I I don't want such things in my portfolio. I think the Noble 30 index, and then I created a pie for it
Mm,
as well, is serving us better as dividend growth investors than the shit that is in those ETFs.
yeah. Speaking of dividend growth investors, what about dividend growth? Where do you see that in dividend safety?
The dividend growth itself,
Yeah,
yeah, I find it important, right? I want to see, I just want to see a growing dividend over time. So for me, for instance, I would like to see at least a 5-year dividend growth be, I guess, about 5% or something like that. It tells me that it's beating inflation and gives me also a margin of safety regarding inflation.
yeah,
It is also needed for my own, how is it, financial independence goals. But if a company cannot grow their bottom line plus their dividend growth above inflation, then what value is it adding to society?
well, not to society, to investors.
Yeah, well, yeah, true. But what value is it adding then, right? It means like it like from all the goods in the world, it cannot outperform it. And we're talking here about the top-notch companies in the world that we are investing
Mm,
in,
yeah,
right? Our companies in our portfolio, they typically have 100 billion market cap or something like that.
yeah. I tend to look at I look at 1 year, 5 year, and 10 years, and I just look at the trend in that. Is it trending up the way? Is it trending sideways? Is it trending down the way? Um, I like to see it obviously go up the way because you know it's getting a bit, but that's not always possible. Usually you would see companies trading sideways. The 1 year might be a little bit up, a little bit down, and we know that could fluctuate. But I just look at the trend and get a
That's
feel
more
for it.
like a momentum indicator as well.
Yeah, yeah.
Yeah, yeah, makes sense.
I
Yeah,
IO charts actually have a really good chart on that you can see
yeah.
the dividend growth, and then they have a yellow line showing you the average dividend growth over the last 20 years or something. So it's quite a good resource.
But again, only for American companies, right?
Yeah,
Yeah.
same
Yeah,
old story.
yeah, yeah. And then the last aspect for me is really important is future growth as prospects. And here comes a little bit the magic, right? You're really having a look at the future. You need to understand their business model a little bit. You need to have a feeling for the market, where there's an uptake for their brands. This is really, really important. And for instance, this is really hard because I give you an example. Danone for me and their business, I really see a lot of future growth prospects there already for 3 years, but the company is not growing as such. So maybe I don't understand the company well enough, right? But I really believe that the vegan trend, if I also go now to supermarkets, I see the shelf availability with Danone products only increasing continuously.
Yeah,
So I don't understand why it is not turning into bottom line. Well, I know one thing, that they have been heavily impacted by the pandemic and their water business, but water business is not their biggest business. It's a high margin business.
yeah,
It's not their biggest business. So this is really where the art of investing comes in. And I guess I'm just as much right as that I'm wrong here.
yeah. I mean, all the rest, everything we spoke of beforehand are absolute. I mean, you get all these numbers from the annual reports. They're all there, and you don't have to make assumptions. They're there. But
And
with
they are backwards looking. Yeah.
exactly. But future growth, you have to make an assumption. It comes from you, your understanding of the company, what you think they're going to do. So this is going to change, obviously, from investor to investor. But it's just important to understand what the company does and what you think it's going to do in the future.
And do you take analyst estimates into considerations?
Nah, they're biased as shit. I don't look at analysts.
Yeah, I find it interesting with fast graphs. You saw that always so nice. You see it in the chart, right? You see it in decline, decline, decline with a lot of those stocks in the earnings. And then you see that the future earnings are always up. And then it
Yeah,
says like in 2 years, you can have what is it, an annual rate of return of 12%.
yeah,
I never saw them going down in the future from all the stocks that I noticed. Yeah. So this is not possible by itself, because if you look at the same chart, the last 3 years it was going down. Why can't it go down further? Like
yeah,
IBM has been going down for, what is it, 8 to 10 years.
yeah, yeah,
Every time in fast graphs, it was promising that it will go up and will go up, and it was all based on analyst estimates.
yeah. I mean, and they can't really predict companies going down because analysts need that information from companies, and they're caught in a situation. So you're never going to see them unless they really truly believe this company is going to shit. They're never going to predict the downward trend. Never.
Yeah,
So I
exactly,
I, I
exactly.
I I take that with a pinch of salt. I don't even look at them. I think
No, me
it's
neither. Me
I
neither.
think it's to me I think it's worthless anyway.
Yeah.
But maybe let's have a look at some of the companies in our portfolio that would fall into these categories. And to be honest, I did struggle a little bit with this because I genuinely believe that the companies I have, their dividends are safe, with the exception of Orange, which is a telecommunications. But I went into that knowing that it's high yield. There's potential for short term growth in price appreciation, and it's not a long term play. So I'm fully aware that they are fluctuating. They have high debt. They have high capex. They have cut their dividend. It does fluctuate. So that's one company in my portfolio that I'm well aware of, that may and probably will cut their dividend when things go sour.
Yeah, yeah, I have the same issue with you. When I look at my portfolio, I still own positions for which the dividend was cut, like Danone
Yeah,
and also Bayer, right? So I see Bayer now as a turnaround play already for 2 or 3 years. So yeah, maybe I should also get a bit more impatient there. So dividend cuts have happened. Most of them that happened was never to zero. It was like 10%, 20%, something like that. Um, so an AT&T, for instance, I sold straight away. Disney went to zero. That one I sold straight away and actually made a profit still on it. So if I look at my portfolio now, the ones that I think have the least amount of dividend safety are 3M and Omega Healthcare because of all the metrics that we just discussed.
Yeah,
I just don't see 3M cutting the dividend anytime soon. They still have so much leverage that they can do on their balance sheet and everything to continue paying dividends. I think they are attached to their I said their dividend policy because they also know that the shareholders count on the dividend as an alternative way of income during these times. Yes,
yeah,
so they are really well aware of the shareholder base. So what's then left is Omega Healthcare. Omega Healthcare has excellent management, I would say, but just the business is continuously at risk. And I get a lot of questions about Omega Healthcare every time when the quarterly earnings are reaching out. I'm keeping it. I think already half of the my stock has been paid back in dividends.
yeah,
But it's like you with Orange. I could see one day this their dividend getting cut, and I'm not lying awake from it because it's a REIT. Yeah, so they will need to pay 80% of their income,
yeah,
and this is also not something where overnight their income will be totally gone. So far it has been doing me well, but this is probably the most riskiest in my portfolio at the moment.
yeah. I also had 3M on my list, and one thing I mentioned it before. When I did the actual numbers and I ran through the absolute numbers on this, they got a dividend safety score from me of 79 out of 100, which appears quite good. But yet I still don't believe that their dividend is safe. And I think I spoke about it 3M before, the growth prospects. I just don't see a catalyst there. I don't see the growth prospects. And then we know then that this lawsuit is coming down, which could eat into their cash flow and ultimately their dividend. So they were on my list. I did sell 3M at 160. I will maybe look at buying them again if they drop to 120. But I did have concerns
But this
about
is interesting, right? What was the catalyst that you saw when you bought 3M?
when I bought 3M originally, they were like a dividend king. They were obviously growing, and it was a stable business, like steady. It
Yeah,
wasn't grow.
but
It
what was the
wasn't growing.
catalyst?
There was no real catalyst, like growth catalyst. I just always felt their dividend was safe. I mean,
Yeah.
the revenue was flat, everything was flat. I just felt like it was safe. But I suppose the difference now is that litigation. I mean, that could have huge implications. It'll no longer be safe. That free cash flow is no longer safe, and they will have to use some of that to pay off these cases if it goes on.
Yeah, yeah, and that's why I was asking these suggestive questions because for me, the growth prospects are still the same as they were in the past. Yeah, because this company is so hard to analyze from a growth point of view. I
Yeah,
mean, look at their portfolio. First of all, 95% of the products, we don't know about them. We
yeah,
don't understand them
yeah,
either. We know duct tape, we know post-its and such, because those are consumer brands part of. But 3M is so much more. So with 3M, you are always a bit in the dark, right? Here, but it's also slow compounder. They will not lose revenue again from one day on another. And with such a company like 3M, it's like IBM. You have like 10 years the time to see
yeah,
it going down, right? So, like you, for me, the dividend safety here is more related to the litigation because I burned my fingers there with Bayer and Monsanto.
yeah.
This is where, and as long as 3M is not able to quickly get a deal on this, like Johnson did, I'm afraid that it will become like a never-ending story and a drain of cash.
Yeah, and that's where the story changed for me, and that is why I got out early. I didn't want to hang around in there, especially when it was trading at a high price. I didn't want to hang around and wait to get burnt. So I took myself out. I have a buy order in at a level where I believe is a little bit more reasonable, more fair. If it does come down, I'll be getting them at an incredibly undervalued price. And when litigation goes away, they'll just go back to steady income, steady free cash flow, and steady dividends. But at the moment, there's too much uncertainty, and I don't want uncertainty.
Maybe, by the way, for our listeners, 3M, ticker MMM, Omega Healthcare, ticker symbol OHI, and Orange, what is ticker symbol?
Ticker ORAN.
Good, good, good.
Yeah, we get that quite a bit. We're guilty of not calling out the ticker symbol, so we will try our best to remember to include them. There's one company actually we didn't touch on. I wanted to ask you about, and it's a company that you are talking about from a dividend safety point of view before. You were a little bit in turmoil about them, which is ExxonMobil, ticker symbol XOM.
Well, I believe that the dividend is very safe at the moment with these cash
Yes.
flows.
Yeah.
Yeah, so you know that since the pandemic, I've been already thinking about selling ExxonMobil. This is such a company that I don't get my head around. I've always been procrastinating in pushing the sell button. I wanted to exchange it for Total Energies. I'm really guilty here for this, and now it's doing really well. They didn't cut their dividend. They increased the dividend with 1 cent. Total Energies didn't do this stuff. While I believe that Total Energies is much better prepared for the future. Now I'm in the situation again. Like, okay, ExxonMobil is doing really well. So if I would sell it now, now the massive buybacks will come, dividends will be hiked again, so they get back on this growth prospect. So I'm really confused in my mind because it's also the cyclicality of this business, right? Of ExxonMobil. So I maybe it's just good that I never sold it, and it's this good old rule of like the best thing an investor can do is just don't touch it.
Yeah, exactly. You've seemed to done yourself a favor by procrastinating. Obviously, at the time, lots of things were uncertain. We always knew oil was going to come back pre-pandemic or post-pandemic. We always knew that was going to happen, but nobody figured that this war was going to happen and going to drive prices even higher. So yeah, maybe doing nothing
Yeah,
is
my problem with ExxonMobil is not so much that I don't understand the oil cycle, but more like I find management in denial around what's happening and what the world is demanding from climate change point of view. So I would like to have companies that are better positioned for that, and I believe that Shell is an example of that. That is much better positioned. Chevron as well,
yeah,
and Total Energies as well. So that's why I was thinking of exchanging ExxonMobil for Total Energies. But now to do it again at the top of the cycle is also so awkward because I might miss out maybe on the right with ExxonMobil. So yeah, probably I just need to start at position in Total Energies like without selling ExxonMobil and still get just a position in Total Energies. I still have a bit of room for energy if needed.
yeah. Awesome. Okay, so we might move on to some questions. We might start off with the first question. A couple of people have asked a similar question. I think Morris, Andreas, and Fire to Pete about our thoughts on Vitaris. We know that they had a sharp share price drop after
They're
their
fooling.
earnings.
It's Beatrice, Derek.
Ah,
It's
Beatrice.
Beatrice. Yeah.
I always get that wrong.
So the share price dropped by I think 12, 20 or 25 or 30% this week after they announced their earnings, and I honestly don't really understand this stock market response. I really don't understand it. So one of the things they did is they decided to spin off their or sell their biosimilars business, which was a real small, relatively small portion of their portfolio. They're selling it to one of this other, I forgot the name of the company, and they get a stake in this company also. So effectively, they still
A small stake.
benefit from this. Yeah,
Yeah.
it made a paper loss for two reasons. One, it had 600 or 700 million. I'm doing this from my head, right?
Yeah.
Looking at it a few days ago, 607 million write-off, which is normal for pharma companies typically, and which was also already predicted. Yeah, that these write-offs would be.
Yeah.
On top of that, they had also a litigation, I believe, for 250 or 350 million on top of that, and that's why they had a paper loss. But cash flow was like, I believe, 2.5 billion or something like
Yeah.
that, free cash flow.
2.7 billion.
And this is what I don't understand, and maybe I don't understand Beatrice well enough. Yeah, because I heard many people complaining about management is not trustworthy. It's the old Pfizer management. It's not the CEO, but the other board members. I don't know those managers well enough to form an opinion around it. So from that point of view, Beatrice, I mean, their prediction is like 7 to 8%, I believe, growth in free cash flow. So 2.5 to 2.7 billion next year. They're going to do a buyback of 1 billion, I believe, on a market cap of 13 billion. So we're getting an 8% buyback yield here at these prices. So I bought some more when it dropped at 11.40. I got also a comment on Twitter like, why not wait? And then I said like, Well, I don't know if it will go up or down. Well, it went down further to 10. So
Yeah, yeah,
kudos to him that he understood it.
yeah,
But it's for me a really small position in my portfolio. What you need to know about Viatra is it has been spun off from Pfizer. Effectively, they created in Pfizer kind of a category like in the taxonomy called other. They
yeah,
put everything under other and spin it off. And what the company is doing now, it is just positioning itself for the future by typical portfolio management actions. So from that point of view, I don't like so much that they spun off or let's say sold the biosimilars, but it's good to know that we will be still a beneficiary of it because of the stake in the other company. So bottom line, not too much changed. And yeah, it has been predicting it will sell more parts of the businesses. So for me, this is really portfolio management, what is happening here. And that's how you need to treat the company. The paper write-offs are like needed from a GAAP point of view and such. I don't look at those. I look at free cash flow. So the question now more is like, what are they going to invest in? Are they going to acquire something that fits within the portfolio? You get the company now at what is it, the 4%, 4.5% yield?
4.4. Yeah,
So for me it to be like maximum 2% of my whole portfolio, I feel totally comfortable with, and it is not even 1% of my portfolio, the position. So I might buy some more next week if it continues to trade at these prices.
yeah,
I believe it could easily trade on their valuation around $18. So this is my opinion here. And ticket symbol VTRS. I also made a video about it several weeks ago.
yeah. I mean, I'm not too surprised that the share price dropped. I'm surprised at how much it dropped. The biosimilar segment was the fastest growing segment as well throughout that year, so that's going to hamper them a small bit. And the pipeline, I'm no expert in this, but the pipeline doesn't appear to be as strong. So they still have a lot of work to do. But I mean, you just gave the figures there, 4.4.
Well, and there's one pipeline which is quite strong there, specifically when you swallow it.
Yeah, but I thought the biosimilars had the strongest one.
No, but come on, hey. But come on, hey, let's say like that. If you're at this midlife age and it's not going up so easy anymore, would you take Viagra or a B product that you don't know?
Oh, you go with the proper product. Yeah,
Yeah, it's like with AbbVie. Yeah, you go if you want to get fake lips, you go for Botox, not some kind of Chinese stuff you don't know, right?
yeah, yeah.
So I think they have something really strong in their portfolio there.
Okay, we'll move on then to the next question. So, like the last one, we got a couple of questions on Unilever, and one of them is, what do you make of their share price drop? And also, I believe Cameron Stewart has done a video about Unilever, and what's your thoughts on that as well?
So I saw the Unilever share price dropping over the last few days, and I have no clue why, honestly. To be honest, I only checked out Viatris this week because I was with my head not with investing at all. I'm actually glad that we have this podcast because I notice already I'm getting positive again in energy in my body, which is really nice to feel after this drama this week. So I have no clue what why the share price was dropping at all. I've not checked the news, but I did watch the video from Cameron Stewart because we had him on the podcast. He's a great guy. He's really genuine. He's one of those YouTubers that no nonsense. Yeah, yeah, no bullshit. And I really got positive feelings for when he's presenting something. So I watched that video, and he's spot on with everything he is saying. So one of his key things was like the company is deteriorating its balance sheet because it's effectively it was around 15 billion increase in debt, but also 15 billion buybacks. What he might not know, and I also pinged him about this because he didn't follow the company so close, right? He looks really cold at the numbers, and with this he's right. And you and I know this but we also know why. When Uncle Warren came by, I think with 3G Capital, they made an
Yeah,
offer on Unilever, and Unilever pulled out its defense mechanism yeah, to avoid hostile takeovers. And that's why they started doing buybacks. And they after that they I said cooled it down a bit again, but lately they started again with buybacks because they know they're a takeover candidate. They just know that by the way they're performing. That's why they want to do this stupid acquisition of GSK, because management is hopeless. Yeah, and I think Cameron Stewart, without understanding maybe management and such, by looking at the numbers, caught it all. Yeah, what you need to know about Unilever. I'm fully with him. The thing and the difference between him and me is that he is a pure value investor, and he wants to have, let's say, 12, 15% internal return on over the next 2 years. I'm a cash flow investor. Yes, I use value investing philosophy to analyze a company to assess the share price. But once I bought, I'm a dividend investor, cash flow investor. And what I mean with cash flow is not the cash flow that Cameron Stewart means. I mean dividends as income. So hey, you get here like a 4+% yielding company, for which I think the dividend is safe. To be honest, I don't see it cutting the dividend anytime soon. The cash flow is covering it. Um, but these kinds of companies, and IBM is also in this category, right? These companies go through a typical S curve. So they in the beginning, when you are like Microsoft had when Satya Nadella came in, the first 2 years they're restructuring all these kinds of things, and a certain moment you see the uptake coming. Yeah, and you go through the spring, and then at a certain moment this market is taken, saturated, and you go again in the autumn. It's clearly here that Unilever is in that space. The issue with Unilever now is there's no sign at all that anytime a spring will come again for them with a new lack of growth. And that is why I'm saying, like, after 3 years or 4 years really closely following Unilever, it's a management issue, not a company issue as such. Yeah, you can say, how can you distinct management from company? I mean, their products are top-notch products. Yeah, the management is just not getting enough out of it because of their incompetence.
Yeah.
And that's where the issue is, and that's what Cameron also really saw well.
Good. Caspar has asked a second part to his question. It's how do you invest right now given the weak Polish currency?
Yeah, this is really, really bad because I've got some savings still. It's also bonus time. I will get my bonus soon paid. So what I did this week, I transferred some zlotys to dollars without necessarily yet investing, because I have my dollar cost averaging, so my savings. I lost on this already like 10% compared to a month ago, which is a lot. Yeah. It's really, really difficult right now. I mean, I'm one of those fortunate positions, probably people in Poland that has savings, like that I can do this, because I guess many people might not have, unless the listeners here, but they are usually in good positions, right? Otherwise, they wouldn't be investing now. But it's really a problem. I lost like 10% of I said buying power in stocks over just let's say 1-2 weeks. And it's not so much with the euro; it's even worse with the dollar. So my portfolio, where the majority of my wealth is holding up really well. It didn't even decline because the dollar got stronger. So my dividend income in euros, because I still calculate in euros, everything went up. And yeah, so from that point of view, it's good. But what I'm doing now, and that's maybe Casper's questions as well, I just transferred today again money to my De Giro account, just accepting that it's the 10%. I was honestly, what he is saying, I was exactly thinking the same. Shall I wait to see how it plays out? But then again, I don't know how it will play out. So, and then I really had to remind myself about the power of dollar cost averaging and what I always advise on the show here. And I have to practice what I preach. So, and that's why I'm doing that. I just transfer money. I know I can buy 10% less than before. On the good thing, maybe I buy some Viatris because I get it for 20% less than last week. So, all in all, not too bad deal then.
Toby has asked, have you ever looked at Michelin? He believes they could benefit from falling oil prices if that ever happens, of course.
So I have looked at it in the past. But Toby, I only remember that I didn't like it. I didn't like their dividend profile. So that was also for me. I actually the sign, like, I never need to look back at it. So Toby, I can imagine your theory here, but I found it a really poor dividend growth stock, and that's why I've never looked into it again. If you think about, I said, of like people more driving, I think you should have seen that in the share price already, because I see more cars on the road since the pandemic got a bit behind us, because less people want to go with public transport. So, yeah, I think it's a really, sorry, Toby, but I think it's a really weak thesis to invest on. I think there are probably some other companies with stronger theses around this. I mean, in this case, you might want to just look into Lockheed Martin. Yeah, if you want to benefit from what's going on with Ukraine, as an example.
Yeah. The Michelin, they make tires, is that right?
Yeah,
Okay, yeah. Okay.
yeah. It's this fat, chubby, white
Yeah,
guy that you see in the commercials.
got it. Yeah. No, I never looked into them. Um, but I'm like you. I don't see how they would benefit from falling oil prices to be.
So, yeah, there's one good dividend stock in America. I think it's Goodyear tire
Yeah.
rubbers. I think that is an iconic dividend stock. I don't know if they had a dividend cut one time, but that's one of those more iconic dividend stocks, I would say, as
Cool.
alternative.
Tim has asked us a question. He said, ask companies that have product revenue coming from Russia or manufacturing in Russia, Ukraine, seem to have been falling more in the past week. How do you see that affecting the revenue or dividend growth long term? A temporary dip or stay away from it? Well, I mean, I don't think it's any surprise that they have been falling over the last week, given the events. We don't know how long this is going to last or what's going. So it's too early to say if it's a temporary dip. But for me personally, I would be staying away from companies like that.
Yeah, I would just just open up their annual report and try to find how much they get from Russia and see if let's say, I don't know, let's say that Unilever gets 5% of revenue from Russia, and if the share decline is 10% based on the Russian news, you know that it's overreaction, right? And this is how I would look at it. Once again, I haven't really thought about investing this week, so I've not looked into this generally.
For investors in the know or that are know about that region investing and those companies, it's probably a huge opportunity out there, particularly maybe more so on the Russian stock side. I mean,
When the
but you,
stock market would be open
yeah,
again, right?
exactly. If I mean, there's obviously risk there, but there could be a huge opportunity there. But I just don't know enough, and I don't want to take that much risk on to do
Yeah.
that.
Yeah, and I honestly don't know if due to the sanctions we can even buy. I saw in the dividend chat that I think it was Dividend Doc that one of his Russian positions was automatically sold.
Yeah,
So by interactive brokers.
which would be quite annoying.
Yeah, I think they can't even do it because you're well, maybe they can, but I would expect they can't because it's my stock. Yeah, not
Mm,
interactive brokers. But yeah,
yeah,
it's a conversation for another time.
yeah, exactly. Tiago has asked us, given the events of the past week, this has brought sovereign risk to the forefront. How does that match up with Baba and its risks?
Well, first of all, my Baba position is like what is it? It went from an average share price I have, I believe, in 170, and it's now trading at 100.
Ooh,
So this is my worst investment decision after General Electric, if you would take it from a share price point of view. To answer his questions, I really don't see an issue with the Chinese risk. I know that Chago is really looking at this. I mean, this is so personal, right? I never want. I got often the question like, EDGI, why don't you buy Gazprom? Yeah, I felt like I don't trust Russia. Yeah, somehow I don't trust China either, from a government policy point of view, but I do trust China from a stock market point of view. So if now China would also invade a country, yeah, I'll be screwed. Yeah, because then sanctions will come. Maybe they do that, maybe not. Again, here's where diversification nicely comes in. If I would lose my whole position in Baba, I will still sleep well at night.
Drip has asked us, when do we sell and what is our decision making framework? Quite simply, if they cut the dividend and the story of the company has changed. So I mentioned I sold 3M. The story has changed for me there. So that's pretty much what I look for.
Same here. I don't automatically sell after a dividend cut, and Shell is the example there again, right? But it's mainly about the story. But Drip, you just heard me talking about ExxonMobil, so I'm not so rational as I might always sound here, I would say. I guess it's good that we have pub talk. We don't need to act. We don't need to talk like investors and I said like analysts. So I can also talk about my weaknesses. So it's not easy to sell, I would say. Biases are always at play. Sometimes I don't know, with AT&T and Disney, it was for me a split second to decide to sell. General Electric, I still have them in my portfolio. Bayer, I didn't sell. ExxonMobil, I didn't sell. Danone, I didn't sell after dividend cut because I still believe in the prospect. But for instance, why I have Bayer, I really don't understand sometimes. I think in the turnaround, but it's not turning around. Yeah,
We're human. We're going to make mistakes.
exactly.
But
So if anything, Drip, just know that we're not that much, that we are not superhumans here leading dividend talk. So I hope that at least helps here.
okay. Future Dividends has asked us, have you ever looked into ticker symbol MGA? He thinks there's a lot of pent up demand for autos after chip shortage and selling off on Russia plants closing. I don't know them. I did a quick Google. They're some Canadian mobility company, but I honestly don't know enough about them to comment.
So something to look up for us and future dividends. Just ping us on Twitter. I'm very curious more if you own them and what you think about it. So yeah, let me know.
Okay, and we have a question from Slint. Utilities are often staples of dividend portfolios. How do you feel about the sector as a whole, and do you have any favorites in this sector?
I actually own really few utilities, and that is for a really simple reason. I'm not living in America, and that's where I think the iconic utilities are that pay dividends.
Yeah,
So I need to at least feel a little bit for a company to invest in it. European utilities, I own Red Electrica as an example. I own Enagas. I consider that also a utility. I analyze them well enough. I also understand Spanish culture a little bit. Spanish people don't trust their government. That's why they try to stay away from those two stocks. But I see them as nice, high yielding stocks, which will not cut the dividends by 50 or 60%. They have already, like, for the next 3-4 years, as a plan about what they will pay, and they seem to be sticking to that. So Red Electrica is ticker symbol REE, and Enegas, I think, is ENG on the Spanish stock exchange. So I own those. I'm not so. I don't get excited from utilities, not at all.
yeah, yeah. Same as I have Energas. I don't have Red Electric anymore. Same feelings. One last question is from El Dev. Why was this war not a black swan event, or at least the market is not acting like it's a black swan event? I don't know.
I think the market is not rational. And secondly, I think we need to look at it from American point of view. Ukraine is there somewhere bordering with Russia. It's not close to America. America is not itself directly involved. I really think that if you take that perspective into account, that there's something happening there. Russia is not like such a world player that it will impact the world economy as such, and that's why I think simply it's not a black swan event. I do, and by the way, you saw the German stock exchange way harder dropping, right? 5% Siemens, BASF. They have a lot of energy-related industry. I really think that that's the reason, and I still think they are, while it's dominating the news, they are still looking more at inflation at the moment.
Yeah. Okay, and I left Rafa for last because I think we'll all agree in his sentiment. But he has said that we live in weird times, and just to share the word of peace and support for all those out there in the middle of the conflict, suffering from anxiety due to the Ukraine invasion. And I wholeheartedly agree. Our thoughts, prayers, and hope for peace is there.
Yeah, and if someone is still listening here at the end, if you know people that are on the run, refugees, ping me on Twitter, on Facebook. We have place here at home for refugees, so no problem at all. If someone needs a shelter, just ping me.
Okay. Okay. And I mean that's it for the week, and we'll see you all next week.